All right, welcome to From Startup to Scale Up Strategies for Financial and Legal Success, our um, webinar series that we're doing, SPDC is doing here in June. And we're very excited today to have Eric Costa presenting about an easy financial model that can help you make decisions as you go along. And we can go to the next slide, please. Oh, I should tell you, I'm Heidi Edwards-Dunn. I'm the Education and Communications Director with SBDC. The Small Business Development Center does two things. We advise businesses one-on-one in a very high, highly confidential, highly exceptionally geared to you experience. There's no cost. We are funded through the U.S. Small Business Administration. And also through the state at the Business and Economics Affairs Office. UNH hosts us, so we are connected to a university system, the university system. Because we are a charter through the that Congress put into effect back in 1980, I think. There's one of us in every state or more, and the U.S. territories as well. So we have a network behind us, which really provides solidity and resources for our clients. Okay, next slide. Our clients have a huge impact on the state's economy. In 2024, the total economic impact of SBDC clients was $254.6 million. That is a lot. We advised over 1,900 clients last year, and those companies supported 6,500 jobs. I mean, it was a big year. We're very excited to have had that impact on so many small businesses in the state. Next slide, please. And we do a whole lot of other things, the educational programs. LEAF is the main program through which this webinar series has evolved. It is the Legal Accounting and Financial Services program, and we have funding through the SSBCI program to provide services, free services, up to 5 hours per business, with either legal services or some kind of financial or accounting service. So if you have a contract that maybe you've got a business and you work with several independent contractors, you can get that contract looked at, or other kinds of things along that line. And Eric is part of this LEAF program, and that's why he's presenting today. And you should check out our e-courses online at nhsbdc.org. Those are there 24/7, and we have 35, I think, at last count, on all kinds of topics, and mostly kind of beginner to intermediate levels, but from how to start your business to how to read a financial statement to digital marketing, all kinds of things, cybersecurity. And then you can see the other programs that we have. Our exporting program was really cool. There's a lot on our website, and you're welcome to take a look there as well. Okay, next slide, please. And now I'd like to introduce Eric. Let me pull up the text here. Eric is a fractional chief financial officer and strategy consultant, and he can explain what that means. He's a seasoned executive with C-level experience in a variety of different industries. He's an insightful and strategic leader who can quickly evaluate complex businesses and markets, identify opportunities, develop strategies, and execute plans to deliver superior performance and value. He prides himself on inspiring his teams and building strong cultures with a collaborative and empowering management style. He has special expertise in building teams, transforming organizations, and leading game-changing initiatives, which means he can also help you do that. Over the past few years, Eric has been providing fractional CFO services to tech startups and small businesses. And through the LEAF program, he's working with a lot of our small businesses. Eric brings both financial and operational expertise to his clients, and he has CFO experience in a number of industries: video games, medical devices, electric vehicles. He's led successful turnarounds, scaled growing businesses, raised venture capital financing, put together strategic partnerships, and led a software company to a successful exit. And we know that so many companies in New Hampshire are at the exit strategy stage. Planning ahead for your exit is really important. Giving yourself, 5 years, 2 to 5 years ahead is really great. And our last presentation of our webinar series, sorry, I'm taking a little trip off here from Eric's bio, is now about thinking about your exit to your business, no matter where you are in your business tracking, so that you are ready to do that when it's time. So that is a change, and we'd love to have you join us for that. Eric has personally founded 2 companies, including an importing and distribution business. His extensive CFO experience is complemented by a strong background in engineering and operations. His early career was in engineering management, including working for IBM and NASA, where he was the project manager of an astrophysics research satellite. Additionally, he's proud to have advised, mentored, and worked with dozens of startups, bringing to market diverse technologies, products, and services. Thank you, Eric. We are glad you're here, and please go right ahead.
Thank you. Pleasure to be here, and thank you everyone for joining us today. We're going to take a look at financial models today. So basically, we'll discuss what is a financial model. I want to talk a little bit about accounting basics, make sure everyone has a little foundation in looking at income statements. Then we'll explain how to build and use financial models to make better decisions. I'll tell you what some key takeaways from the talk are, and then give you an opportunity for a Q&A session. So let's kick it off. Do you sometimes feel like you're flying blind in your business? I sometimes hear small business owners say things like, how can I know if I can afford to do these projects this year? How much money will I need? Are you making important decisions based solely on your gut and by how much cash is on hand in the bank? Would you like to make decisions using data and financial analysis? Let's learn to make data-driven decisions using a simple financial model. It might help you sleep a bit better. A few caveats. Today's session is targeted towards very small businesses. Those kinds of businesses typically have some different priorities and concerns than larger businesses do. In particular, cash management is always an issue. So today's session is not about how to use models or financial analysis to help you make better strategic decisions, like, does it even make financial sense to launch this new product? No, we're not going to go into that. We're going to assume you know what you want to do and why you want to do it. Today, we're going to focus on giving you some tools to help you manage your cash and inform your decision-making at a tactical and operational level. So what is a financial model anyway? It's a spreadsheet, of course. And spreadsheets, of course, are only as good as your data and your formulas and how well you put it together to make it usable. What does a financial model do? I mean, it's basically a planning tool that helps you forecast the expected financial performance of your business. It does this by pulling together your assumptions, your plans, your estimates, your forecasts, and then presenting the expected financial results based on those inputs. This allows you to analyze the financial impact of different assumptions you might be making and decisions that you are faced with. A financial model can help you understand where you're going and guide you. It'll allow you to make decisions based on data and analysis, not just your gut, though your gut is sometimes important as well. It can give you an idea of how lets you understand how much you can afford to spend, which is especially useful when you're making decisions about starting new projects, programs, expanding your business, expanding your staffing, etc. It can help you chart your future course of action and test assumptions in different scenarios. For example, you can test different sales projections, growth rates, cost increases, pricing assumptions. You can understand the impact of the assumptions you're making and test results under different scenarios. What if those assumptions aren't true? You can easily play with it and look at different scenarios of whether you choose to do A or B. A well-designed model is built to make it easy to test different assumptions and scenarios, and that's what we're going to show you today. It's helpful to look at both optimistic and conservative forecasts when you make decisions. And models let you do that. Before we get into the models themselves, let's review some accounting basics. It's very helpful to be comfortable reading financial statements before you build a financial model. There's a lot of different jargon in accounting, and sometimes different words can be used for the same thing. There are two main financial statements that you probably have already seen and heard referenced. There's the income statement and the balance sheet. An income statement, also known as a profit and loss or P&L, measures the performance of your business over a period of time, which could be a month, a quarter, a year. And largely, you're looking at the revenues during that period of time, your expenses, and showing whether you made a profit or a loss, how much profit you made, etc. A balance sheet, on the other hand, is a snapshot of the health of your business at a single point in time, like the end of every month or the end of the year. It looks at the assets in your business, cash, amounts owed to you, inventory, things like that, and compares that to what you owe, your liabilities. And the difference between those is the equity you've built in your business. Now, income statements are a great starting point for a financial model. So let's look a little closer at them. These are, you'll hear a lot of different terms, and largely they mean the same thing. Sometimes it's revenue, sometimes it's sales, sometimes it's income, which shouldn't be, don't confuse income with net income, but that's really the money coming into your business. Then there's the cost of goods sold, also known as COGS, sometimes referred to as direct costs, because COGS are the direct costs used to make the product or provide the service. The difference between your revenue and your COGS is gross profit. And you'll also hear the expression gross margin, which is gross profit represented as a percentage of sales. Then there are expenses, also known as operating expenses, often referred to as overhead or indirect overhead. These are the other expenses that are associated with running your business. And once you've paid your COGS and your expenses, what you're left with is really your operating income. You'll also sometimes hear the term EBITDA, and what that is basically your earnings before interest, taxes, depreciation, and amortization. And basically operating income and EBITDA are essentially the measures of your company's, ability to generate cash. So usually what you want to do is present, depreciation, interest, income taxes, things like that below operating income. At the end of the day, though, after all your expenses and everything is accounted for, you're left with your net income, also known as your profit or your loss. That's the final result. Financial models usually start out resembling income statements. So let's take a look at some sample income statements. And note that I'm going to be ignoring income taxes today to keep things simple. There's two common formats that you'll see income statements in. One presents sales and then expenses, and then just nets the difference as profit. A more sophisticated version will actually take your cost of goods sold and separate it out so you can see what your gross profit and your gross margin are. And then you'll take your interest and your depreciation, and put it, as I mentioned, below operating income. So you can see your operating income, and then at the end of the day, here's your profit. So you've got your sales, your gross profit, net out your expenses, and you got your operating income, and then net out these other expenses, and you have your final profit. And note that depreciation is a non-cash expense, and that's important when we're talking about financial models, because financial models, we're going to be looking at cash. Service companies, by the way, and many small businesses don't even bother to separate out COGS. And that's especially true in my experience when labor costs are the main expense in providing the service or in making the physical product. So then you often see an income statement that looks like that. Just a couple of tips on reading your P&L. Make sure that your product prices have enough margin to cover your operating expenses and actually make a profit. Always try to compare results to prior periods. That's where you're going to learn a lot and see if your business is headed in the right direction. And even look at individual accounts for trends over time. I don't want to spend much time on this, but this is an example of the kind of thing you should periodically do. Take a look at your business's, how it's looking month by month, and look at individual accounts and see what you notice. So like you can sort of see here that the sales are kind of trending up. Is that because your sales are growing, or is it because you have a seasonal business here that's slow in the winter? You might say, gee, why are repairs and maintenance so high in here, whereas normally they're much lower? These might not be the best examples, but they happen to be a couple things that were on the data set that I pulled for this webinar. Just an example of how you can, learn about what's going on from your business. But now let's dive into actually building and using financial models. We're going to start by discussing how to build a simple model, and then we'll discuss how we can use it to make better decisions. Financial models, as I alluded to earlier, focus on cash. So you typically want to start with your income statements, a cash-based income statement. Now, most small businesses use cash-based accounting. Some companies use what's called accrual accounting. I'm not going to get into that today. If you do use accrual accounting, you can probably generate cash-based income statements from your software anyway. Typically, what you want to do is start building your model by populating a spreadsheet with historical data from your business over at least a 12-month period. And that is your income statement data I'm talking about here, your income statement data. Then, remove non-cash expenses like depreciation and add new rows for debt service and capital equipment purchases. I like to say, instead of showing just your interest expense, put down, what your total payment is, which includes principal and interest. A little easier to understand that way. So you're just taking your income statement and kind of tweaking it a little bit for all cash expenses that you have to account for. Then you want to start building your forecast. So now you have at least 12 months of historical data. Now you want to look into the future, at least say 12 months. So for each account on your income statement, you're going to prepare a 12-month forecast. For many accounts, you're going to want to use a formula that basically starts with a base amount, which I'll get into in a minute, that is adjusted by a variable factor you can play with, like increase or decrease by X%. So you type in the spreadsheet 10%, plus 10% or minus 10%, for example, and it will tweak the base amount for your forecast. Now, what is that base amount? If the account is roughly the same amount each month or goes up and down within reason, use the prior year's average for the base amount. If the account is seasonal or specific to certain months, reference the same month from the prior year for the base. If the prior year figures aren't really a reasonable starting point, like for example, you have a new hire, rent, or payroll, just manually enter your best forecast for each of the months, or use a more appropriate formula. Now let's take a closer look at what that might look like for a few accounts. So in this case, what I've done is I've decided to put all my assumptions in here in blue. So for a couple accounts, for example, gross wages here, maybe last year your average was 6,000, but you know that your new payroll is going to be about 7,000 a month. So you just manually put that in. Same thing with your taxes and benefits. So now you have a better information. So that's what you're going to use as your forecast. Now, let's say last year, supplies, uh, bounced around, averaged about 15.25, and you think it's probably going to go up a little bit. So you basically create a formula that uses the average and adjusts it by this 10%, which you can then play with. You can make it, well, what is my business going to look like if it's 20% instead? Now, maybe repairs and maintenance also bounced around a little bit. So you want to use the average, but you think you're going to be able to cut those expenses this year. So you put it in at minus 15%. So you can see here, in each case, you're referencing the monthly average and you're adjusting it by a variable. Now, let's say, you have a seasonal business here and you don't do that much advertising in the winter. So the average is pretty much meaningless here because you ramp it up and do a lot more advertising later. So what we're going to do is we're going to use the prior year's month and we're going to reference it. So let's say you say, okay, I'm going to keep my advertising about the same level this year, next year versus last year. So you're not going to adjust it. You're just going to use last year's January. So this basically says, okay, last January was 400. So we just each month look back and reference the prior year's month. Now, maybe insurance is something you pay on a quarterly basis. You want to account for that rather than using the average. And you have some, maybe the insurance company sent you a bill and it's going to be 10% more expensive this year. So you basically reference 12 months earlier and you bump it up by 10%. And that's kind of how you can use some simple equations to sort of start building your projections. Now let's finish building out the model. You want to add new rows for any new anticipated sources of cash and/or expenditures. Don't embed them into existing rows. Create a new row. Example, if you're rolling out a new service or a new product, add a new line to capture the estimate of the revenue you expect to get from that new product or service. Then don't forget to add rows for expenditures that don't show up on the income statement, like your loans, as I mentioned earlier, and purchasing of capital equipment. And similarly, remove the non-cash expenses like mainly depreciation. For each month, you're going to calculate the beginning cash and the ending cash. Now, record how much cash you have today, and that's your starting cash. And this is a condensed look at what it's going to look like. You want to organize the layout for ease of use. So you can sort of see, and what I like to do, by the way, is I like to group all new activities that you're considering doing down in a working area down here. It makes it easier to play with and adjust rather than embedding it into the historical operations. Put it down here where you can see it. So you can see your starting cash. Here's your cash receipts. Here's your normal operations expenditures. So here's the net cash from your operations. Then you have your loan payment, principal and interest. So that gives sort of a cash available sort of before you do new projects and plans. So now let's say you're planning to do a new website. And if you actually did spend 5,000, this is what your ending cash would be. And as you can see, the ending cash then gets pulled up here to be the starting cash the next month, et cetera, et cetera. So now you have got a completed model. On the next slide, we're going to take a bird's eye view of it. You probably won't be that readable. I just want to give you a sense of what it looks like in the big picture here. Then we're going to dive into how you can use the model. So here's what it might look like. I've hidden, of course, the historical data, but let me just take you on a tour. So these are your projection months. I've hidden all the prior historical data, but I am showing the monthly averages here. So in this section here, you have your cash on hand and the incoming cash. And note that the sales from new services we're separating out here. We're not embedding it in with the historical sales that you're already doing. This is something new. You want to highlight it out here. Here's cash paid out, your expenses basically. Here's your debt service and financing. We might even have provisions for drawing on our line of credit and paying, back a line of credit. You can track all this down here. And then here's the new projects and plans that you might be considering and how you're sort of laying it out here. And then, of course, importantly, you're looking at where your ending cash each month is. And then, of course, in this area, as I mentioned before, are all your assumptions. You can visually quickly see, okay, these accounts here are all using the average. These accounts here, I've, not using the historical data. I'm doing it on my own. And other accounts, we're going to use the prior period. We mentioned before, sort of insurance, quarterly expense. All right, let's move on a little and start using the model for planning. So let's say you have a seasonal business here, and these are the projects that you're considering. Well, you take a look at putting all the projects in, and unfortunately, your business is losing money in the winter until your business starts to boom later in the year. And so you got to conserve your cash. And you don't know, you want to do some of these projects in the winter when you have time, maybe, but you don't know if you're going to have enough cash for it. So you kind of plug some of these things in and you say, whoops, I'm in trouble if I do all these things. I don't have enough cash. So I'm going to need to change my plan. This is what I would love to do. Can't really do it all. So what are we going to do? Well, let's change our plans. All right, you decide, okay, the special advertising campaign is really important because I'm trying to get this new service off the ground. So you're going to prioritize that ad campaign. You're going to leave it in there. You say the new website, that's going to have to go on hold. I'm going to just drop that out and maybe pick it up at the end of the year or something like that. And you just have to live with your current website. You realize, okay, I think I can delay hiring this part-time worker by a couple months. So I'm going to save a couple months there. And you say this piece of capital equipment, you can't afford it, at least at the time that you wanted to get it. You decide that you can wait to buy it, and you doing some shopping around, and you think you can make do with a lower cost piece of equipment. So you bump it out here to August. And now you have something that makes a little more sense. Your cash goes from 20,000 beginning of January, drops down into the 7,000s for couple of months until your summer business starts booming and your cash balances start increasing again. And now you've got the new advertising campaign going, you've got a new person coming, you've got a new piece of capital equipment coming, and you have a plan that you can sleep a little better on with. You can use the model to test different assumptions. For example, let's say you were assuming up here that you were going to increase your sales by 10%. Again, it's seasonal business, so you might be saying, okay, 10% over last January sales, 10% over February's, 10% over last March's, etc. Keeping in mind that it's sort of slow in the winter. But you say, wow, what if cash, what if sales isn't going to go up? That means these losses are going to be even lower. And I'm a little bit nervous about that. Well, what does that look like? Well, let's drop the assumption down to 0 and see what that looks like. And then maybe that means you now say, well, I think I can ramp up these new services faster. So let's see what the business looks like if sales don't grow, but I can get the new services going faster. So you can play with it, and see what the end results are under different scenarios. It's the same thing as when we were doing the expenses, how we could play with things there. So model building tips, obviously, as I think I've tried to emphasize here, is use formulas whenever possible rather than hard coding. it's just so much easier to test different things when all you have to do is change a 10% to a 20% or something like that. Try to make all your assumptions clearly visible, and that even includes things like what are you assuming for those, for example, the new sales, the sales of the new services. Don't hard code it in to your forecast. You want to see it, make it real easy to change and really visible. Don't embed numbers like growth rate assumptions in formulas. If you're assuming that your sales are going to be growing month over month, don't embed it into a formula that's hidden. Reference it. And then another tip is use color coding to identify important cells. I did it a little bit in the model, but you can do even more than I did there. Lots of different colors to choose from. I've gone through this a little bit fast. Let's take a moment to regroup on some of the key takeaways here. I hope I didn't rush too fast. But basically, you want to understand your business by looking at your historical accounting data. You understand how it works. What's the underlying physics of your business, essentially? And your historical data can really give you insights into how your business actually works from a financial money-making point of view. You can use that information to build a financial model based in part on that past data, but also using your own knowledge of what is changing. Make sure to build a model that's flexible, that's easy to, play with. That's where you're going to learn a lot. I can't overstate this enough. Show your assumptions clearly so they're easy to change. Don't bury them in formulas. So many businesses I see that know to make a financial model. I look at their model and their assumptions and their growth rates are all embedded in formulas, so you can't even see what they're assuming, and they don't even know themselves after a while. You have to go hunt in every cell to see what's going on. That's not a good model. Then use the model to help you make data-driven decisions instead of relying slowly on your gut instinct. I hope you've seen that by playing with some numbers, you can really gain some confidence that your plans are going to work. And obviously test, optimistic forecasts and conservative forecasts, and make sure that you're not going to run out of cash. Use it to test different assumptions and scenarios. What if I launch this product line? What if I don't launch this product line? What if I expand into a larger retail space? What's that going to cost? What does it look like financially? And when is that going to start paying me back, rewarding me with more sales, for example? So that kind of ends this walkthrough of financial modeling. I want to open it up to a Q&A. Give you an opportunity to ask questions. And I do have actually the model that I sort of mocked up for this presentation available in Excel that we can kind of take a look at closer if anyone wants us to. But let me turn it over to any questions you guys might have.
Eric, that was awesome. We do have some questions populating right now. I am curious as to whether you could speak to maybe a cadence or how frequently you would suggest that people do their modeling
That's
to
a
kind of
great
empower
question.
them.
That's a great question, and I consider putting in here that the model can also be used to, afterwards go back and look how closely were your forecasts to what you modeled, and I considered adding that into that session, and that is the logical next step. I typically recommend that you do it quarterly. Take a look. Let your business run for 3 months, then go back and take a look at your model. What you based your plans on, what you based your decisions on, and how is the business tracking compared to what you forecast. And that might then dictate that you want to now update your model going forward for an additional period of time. But yeah, you're absolutely right. You want to look back ideally, and compare your assumptions, like how good were your forecasts, how good were your assumptions.
That's great. So
Yeah,
quarterly, just so you have enough information to work off of, can test
that's right.
assumptions and then revisit.
Yeah, yeah. And
Okay.
sometimes, if you're busy, then, maybe you wait for 6 months. It depends much, uh, how much the business is doing to give you enough information to know whether your forecasts are uh, roughly on track or not. You want enough data in there to establish whether your assumptions are reasonably close or not.
Got it. So I know that you said that you were willing to share the presentation and some supporting resources. We do have some people that have expressed that they're not Excel wizards and that this is kind of them dipping their toe into the water around
Yeah, yeah,
leaning into understanding and playing with their numbers a little bit more.
yeah.
And they'd mentioned to like a simple template to work with to start, or if you have any suggestions for somebody who's just dipping their toe in the water right now, coming in a little
Absolutely.
uncomfortable. I
Yeah.
think some of our attendees would love to hear more.
Yeah, I noticed that SBDC has a downloadable template. I think it might be a useful starting point. It doesn't really give you the ability to do the kinds of modeling that I'm talking about here. And uh, so if you wanted to get started, you could start with that. And basically, you wouldn't have the ability to do a lot of the adjusting of variables as well. Um, a model like mine, you basically want to know just a couple simple equations. There's very little sophisticated stuff going on. You basically want to know how to reference cells in simple equations. Um, that could probably be learned really quickly with a sort of simple YouTube introduction to Excel course. Or one of the best things is sometimes looking at um, um, the equations that someone who's already built something for you and seeing how that works. I do agree, if you don't have any experience in Excel, it's a little bit trickier, but all you really need to do is the most basic, mathematical operations and cell referencing. So it's not using any of the, powerful features. And you can do this obviously in Google Sheets as well.
Yeah, great points. And this might be a good plug for business advising with the SBDC. If you are dipping your toe in the water for the first time, the SBDC advising team does this stuff all the time. So if you're looking to play in what feels like a safe environment to test it out, schedule
Yeah.
some time with your business advisor. If you don't have one, certainly request one on our website. But they're very familiar with it as well. And if you're not familiar with the LEAF program and have not checked that out, certainly ask your business advisor about it, because you get to work with awesome people like Eric. Um, Eric, it looks like we have some other questions that are kind of populating in the chat, but kind of touching on that same vein of like, it seems like oftentimes people do fear numbers and like digging into, um, okay, no, it was just a positive, like you're the best was one of the comments we got in there. So we love seeing that. Uh, can
Well,
you
thank
speak more to say like, thinking of this process through the lens of it being a positive experience and having a better handle on your numbers to really like for your business to thrive? I think we get a lot of people that come through that are really almost see their numbers as like the enemy and fear them.
you.
But this modeling exercise is really a great way to tinker and think creatively about all aspects of your business and keep a good pulse on it.
Yeah,
Um,
absolutely it is. I'm going to stop sharing the presentation for a minute and put up the spreadsheet. It's just in case we want to look at different parts of it. Sometimes it helps to visualize that. Uh, Pardon me for a minute while I find the, yeah.
Here's another question for you while you're pulling that up.
Okay.
And
Yep.
that joined a little later. I'll let you answer this, but did you say that loans should or should not be on the income statement? I did hear you say they can be put on the 12-month spreadsheet.
Oh, yeah. So I may have glossed over that. Interest expense appears on income statements. But when you're paying off a loan, you're paying both principal and interest. So a portion of your payment is the interest, which hits the income statement. A portion is the principal, which reduces the liability on the balance sheet. For a financial models point of view, what I think you should be doing is removing the interest expense and instead putting down your loan payment, including both principal and interest. So if you're paying $900 a month, a portion of that's the interest, which goes into the expense, and a portion of it is principal. So this is a way for, modeling that you would do it. And obviously you remove depreciation because even though that appears on the income statement, it's a non-cash expense. On the flip side, when you buy capital assets, like a new production machine, for example, that's not going to appear on your income statement, but it needs to, be on your modeling forecast, unless you're taking out a loan to buy it, that's a different situation. But if you were going to buy this from cash in the business, you would put it here. So what else? What else can I show you? So I'll just. Are there any other questions? I have opened up the chat, but I'm not sure I've got everything.
So we may have a few more that populate, but you're welcome to dive in and speak more to this awesome spreadsheet that you just pulled up.
Okay. Yeah. Mike, if I missed any questions, please jump in, interrupt me. So yeah, just showing you a little bit more. Obviously, way out here, this is the historical data, and I kind of collapse it just to make it a little easier to view. You can hide it on a spreadsheet. Again, the people that were asking about the formulas, like this is what the formula looks like. It's pretty simple. It's basically you're referencing the average and then multiplying it and adjusting it by the assumption. And what if you say, okay, I actually think it's going to go up 10%. Watch what happens over here. Here's this 1296. If instead of decreasing, you think it's going to go up by 10%, you just change that, and whoops, now it's much more expensive, just like that. If you think you can test your sales this fast, so this is 10%. What's your numbers going to look like if it's zero? If it doesn't go up at all? What if it's even worse? What if it drops 10%? Boom, just like that. Flows through, and you can see what it's doing to your cash. Just simple as that. You can really quickly test a lot of assumptions. And again, I like playing down here where you can move things around. You can just sort of drag this. Okay, let's do the website here instead of there. You just play around, look down here until you are comfortable with the result. Here, let's get this back up to 10% increase in sales. And, you play around down here and you decide what level of cash are you comfortable with. A lot of businesses, you want to be targeting at least 1 month's worth of expenditures if you can. Keep 1 month's worth of expenditures in the cash in the bank. May not always be possible, but that's sort of good. So ideally, this business would love to have at least $20,000 in the bank, but that may not always be possible. And if you have access to a line of credit, you can sort of decide if you're going to use it for a period of time here or not. All this you can play around with and test different assumptions and scenarios.
Eric, in your conversations with as participating in Leaf and working with clients, do you find that most people are mentally doing these kind of calculations in their head on a day-to-day anyways? And most of what you're showing today is just taking that, putting it to paper in essence, and kind of making sure that it's all.
I haven't found that actually. I found mostly what I've seen is they have X amount of cash in the bank and they feel like that's their pool of money to spend on projects. And they in fact, I've had a couple clients where they just really didn't know because it's too much stuff going in and out, and until you put it down, you just can't do it in your head. Yeah, maybe you can for one thing. If the only project on your plate is doing a new website, you wait until you feel like you have enough cash in the bank and then you do it. But if you're juggling if you're launching a new product, expanding a new space, you're trying to figure out when to do hire some people, and there's a lot of moving pieces, and you can't do it in your head.
Got it. So you're
Yeah.
saying that a lot of people are just kind of operating off of what their balance is in their account, and probably starting first step would be just garnering all the information, starting to build out a few months of numbers for the sheet is a great way to start. So they have
Yeah, it's
clear
a great way
goals.
to start.
They
Yeah,
can
I
start
think a lot of
planning.
people, they do is this is what cash I have in the bank, and these are the 5 projects I want to do, and they just don't have a long-term plan. It's just sort of, okay, I'll do this project now because I can afford it. And there's no real plan of, okay, when are we going to do what? And I personally don't think that's the best way to run your business. It's sort of flying blind. You don't know when you're going to be able to afford that new hire or attend that trade show or whatever, or buy that new machine. You're just sort of waiting until you have the cash, and then you're picking amongst the things. Well, these are the 5 things I'd like to do. I'll do this one because I want to do this one the most, so I'll do that first. Or maybe that one's too expensive for now, but I can do one of these other less expensive things. So that's kind of flying by the seat of your pants instead of really planning your business and putting together what I would call an operational plan for your business.
Got it. Yeah. Great information. Do we have any additional questions from our attendees? If you do have questions, this is a great time to pop them in the chat. Eric has a ton of background and knowledge and would be happy to answer any questions. But as we're waiting to see if anything else pops in the chat, I do want to thank everybody for coming to today's webinar. Tons of great information. If you're not already working with an SBDC business advisor, feel free to visit our website, nhsbdc.org. That red button right on the homepage to request advising is where you'll want to go, and we can get you paired up with an advisor. If you're not familiar with our LEAF program, we have a ton of consultants working through the LEAF program, providing a ton of value to our clients. Definitely take a look at the LEAF program. It's absolutely wonderful. It provides 5 hours of consulting services for various things, including what Eric is working on, as well as some of the other sessions we've had this week focused on legal. But great program. Encourage you to check that out in our business advising. So Eric, it looks like we don't have any additional questions today, but I'm certain that you gave a lot of information and questions and things for our clients to think about. So thank you so much for participating today, for sharing all this information, and for your participation in the LEAF program.
Well, thank you very much for having me, and thank you everyone for joining. And it's been a real pleasure, and good luck. Take care, everyone.